When you think about this move to central clearing, at the time we're seeing in Treasury markets today, how much volatility could that introduce as we see, let's say, a change in liquidity conditions?
Yeah, so I think that's why the SEC gave a very long, let's call it on-ramp. It's going to take 2.5 years till this mandate has to go through, Treasury cash, like you mentioned, and repo. So I think they're hoping if we go slowly, it won't be a jolt to the system, because you're right. Even though it's set to stamp out systemic risk, there are people saying, some of the higher costs and fees may, tamp down regular day-to-day liquidity in the Treasury market. Not a lot, but, you might see bid to offer spreads widen a little bit,
And if you do see some hiccups, where would you see them? Would they be in the repo market in particular, given this move? There's a sense here that the cost of margining could change.
Yeah, I think, their goal is that this will make less risk in the repo market, right? That we won't have these systemic events like we've both talked through many times, that the repo crisis in 2019, and in 2014 we had a flash rally in Treasuries. No one kind of knew what happened. And 2020, we know what happened. The Fed had to come and backstop the Treasury market. So I think they're hoping that this will create less risk. However, like you're getting to, there are things people say, people are doing things like the basis trade, which some people hate, some people like, that some people say it's providing liquidity, that there might be less of that. So I think we have to see, again, there's going to be a lot of stories to be written in the next 2.5 years as they unfold this. But, I hope it works, and that's the kind of theme that, we saw that after Lehman Brothers collapsed in 2008, that they pushed derivatives to central clearing platforms. That was a long on-ramp. That seems to have worked. So I think there's the same kind of thinking, even though this is the Treasury market.
You and I talk about this a lot, this idea that even when you reprice interest rate expectations on the short end of the curve, there could be a lot of changes, too, in how traders are viewing the long end of the curve. We've heard everything from a drop down to a 3% on the 10-year to a hop higher to 4.5 to 5%. Where is there the most risk for Treasury traders today?
Yeah, I think the long end is the hot spot, because you're right. There's a lot of people saying steeper curve. I don't like the long end, because what if we have some supply glitches? We want more term premium. What if there's some other issue? And then you have some people, I forget who it was, somebody said, hey, they're underestimating the risk that the 10-year could go to 3% from over 4 now, right? So I think that's the hot spot. I mean, we've done stories on everyone thinks the curve's going to steepen, but that's kind of going in fits and starts, so we have to see when that pans out. Usually when the Fed cuts, you actually get a steepening because the short rates go down faster, but Fed is saying we don't want to cut too soon, so that, like you said, the market's having a battle with the Fed right now and pricing in more cuts than the Fed's saying. So I think there is risk in the curve, more in the long end. That's why, like you were saying, Matthew Hornbach and folks, Morgan Stanley, JP Morgan are saying we like the sweet spot as like the 5-year note. That's where the best upside looks to be.